The views expressed during today's webinar are those of the speakers, not of Stratford, the speakers' firms or clients, and are not intended to provide legal advice. We have gathered an authoritative panel of elder law practitioners to discuss the key points for elder law counsel to understand and weigh when drafting first and third-party special needs trusts. The panel will also outline the potential hazards for counsel when amending special needs trusts. Our panel today includes Elizabeth Gray, a partner at Matson, Miller, Cosa, and Gray in Fairfax, Virginia. She's joined today by Howard S. Crux, a partner at Elder Law Associates in Boca Raton, Florida. And rounding out our panel today is Ellen Morris, a partner at Elder Law Associates in Boca Raton, Florida. Howard, when you're ready, we'll get started.
Okay, good afternoon, everybody. Great to be here. I'm going to run everybody through an overview of supplemental needs trusts along with public benefits considerations, and then Ellen is going to talk to us about the relationship between guardianships and supplemental needs trusts, followed by Elizabeth, who will talk about tax issues, and then we're going to get into some drafting considerations and some pitfalls to be aware of. So with that, let's start off with the problem that is typically presented when a person who has a disability has assets and they want to also qualify for government benefits. And when we talk about assets of an individual, there's a lot of different ways that a person can come into assets. They either own those assets before the onset of the disability, or perhaps they've gotten assets as a result of a personal injury action that was brought and which caused the disability, and that's what caused them to receive either a settlement or some type of an order of the court awarding them assets. They may have received money from a family member or another individual. Perhaps they got the money through some type of matrimonial settlement, and in some cases we've had clients who've gotten some retroactive government benefits payments in lump sums that causes them to now have assets which they didn't have before, and they need to know what to do with those assets. When you have an individual who receives this money, they have a number of different options. First of all, they can receive the money and they can decide if they want to engage in some type of gifting program or transfer of assets. But for SSI and Medicaid, there are penalty period issues that arise whenever there's a transfer of assets, causing a disqualification of government benefits eligibility. So that may not always be a good option. Another option is to spend down the money, and at that point, once you've spent down to the appropriate resource allowance, they will be able to qualify for government benefits, but during the spend down time, they would not be able to do that. And then, of course, you have the problem of once you've spent down, you don't have the money anymore, so that's not going to give them the ability to ensure a higher quality of life. Another option, rather than accepting the money, is to look into one of these so-called exception trusts or supplemental needs trusts. And generally speaking, the benefit of these types of trusts is that the assets in the trust are disregarded both as available income and resources for Medicaid purposes and other government benefits purposes. And they're not assets that are owned by the person who has the disability. And the further benefit of one of these types of exception trusts is that there is no penalty period upon the funding of the trust. Just to the host of the seminar, if you guys can look into some feedback on the line, I'm getting a lot of shuffling of papers and feedback. Thank you. So when we talk about an exception trust, there are essentially two kinds we want to be familiar with. One is the first-party special needs trust, and the second kind is called a pooled supplemental needs trust. So we're going to break those down for you now. With regard to the first-party trust, it's also called a self-settled trust. It's also referred to as a 1396 PD4A or a D4A trust, which is the federal statute that gives us the authority to create these kinds of trusts. You may also see it being referred to as a payback or a first-party trust. And then with respect to the pooled supplemental needs trust, that might be referred to as a D4C trust, which references the different section of 1396 PD4 under which that type of trust is created. You may also see another kind of a trust, which we're not going to be covering today in any great way, which is the so-called Miller Trust or D4B. Ellen's going to talk about how those trusts get created in a connection with guardianship proceedings. But other than that, we're not going to spend a whole lot of time on the D4B trust. But those are your three 1396ED trusts, 4A, 4B, and 4C that you're going to want to be familiar with. So now let's break apart the first party special needs trust. There are a number of parameters that you have to be aware of when you're setting up this type of trust. Again, here you're talking about the assets of the individual that we're trying to protect, not somebody else's funds who might be wanting to set up a trust for the benefit of the person who has a disability. Those are third-party trusts. So we have the assets of the individual, and we need a mechanism to protect the resources because they have a disability and they don't want to lose their government benefits. If you're going to do this kind of a trust, it's going to be in writing, it's going to be irrevocable, and it's going to be inter vivos. There's no, there's no testamentary D4A trust. They're all set up while the person is alive. A couple of other parameters you have to be aware of. The first-party trust has to be created for the sole benefit of the individual that has disabilities. You can't have a D4A trust that has as a named beneficiary the person who has a disability and a number of other beneficiaries, because that would clearly violate the so-called sole benefit rule. So that's a big issue with the Social Security Administration. It's a big issue with Medicaid. They're always looking to see that the trust was created and drafted properly, that it is for the sole benefit of the person who has disabilities. And then the next phase of that is not only is it set up correctly, but is it properly administered? So during the entire lifetime of the individual, is the trustee properly administering the trust for the sole benefit of the person who has disabilities? And if you make improper trust distributions during the administration of the trust, which violates the sole benefit rule, you may find that you have a trust that is deemed invalid by the government agency. The other thing that you need to be well aware of when you're creating a first-party special needs trust is that these types of trusts can only be created when the individual is under age 65. So if you have somebody who's over age 65, you're not going to be able to create a D4A or payback trust, first-party special needs trust. You're going to have to look at some other options, one of which may very well be the pooled supplemental needs trust, but the D4A won't be an option for that case. With regard to the establishment of a D4A, the statutory language provides that it must be established by the individual's parent, grandparent, legal guardian, or a court. Those are the only four persons or entities that are permitted by law to establish a D4A trust. NALA, the National Academy of Elder Law Attorneys, is currently advocating for a change in this area of the law so as to allow the individual, him or herself, to be able to create this type of trust in recognition of the fact that just because a person has a disability, that doesn't necessarily translate into the person not being able to set up and be the establisher or creator of their own D4A trust. They may have some physical limitations, but that doesn't mean that cognitively they're unable to be the creator of such a trust. And historically, if you look at the legislative history of D4A, there is really nothing in the legislative history that would explain why the word individual was left out of the statutory language. And as we're going to learn later on, in the case of setting up a pool trust, the individual is permitted to set up his or her own pool trust. So it seems really unfair that you can't set up your own D4A, but you could set up your own D4C. The Special Needs Trust Fairness Act, which is Senate Bill 1672, is floating around in Congress. We were hoping it was going to get passed recently because it was attached as an amendment to the so-called SGR bill. That ended up not happening, so now it is still out there as a standalone act, which NALA is trying to get attached to some other form of legislation or adopted on its own as standalone legislation. We'll keep everybody posted through NALA as to the progress that we make with regard to that. So as things stand today, you still have the four individuals or entities above, parent, grandparent, legal guardian, or court, that can set up a D4A, not the individual. When you set up the D4A, the assets are not available. Any distributions out of the trust are not deemed income for government benefits purposes. The thing that you have to be careful of is that although there is no SSI or Medicaid penalty period, remember we said that this trust has to be established before the age of 65, but if the individual were to make any contributions after age 65, depending upon your state, you may end up having transfer penalties imposed on the contributions that are made after the person reached age 65. So you've got to be careful about doing that and making sure you're aware of how your state treats those kinds of contributions in your own jurisdiction. With regard to other people contributing assets to the D4A trust, that's a no-no. Recall that we said that there is a payback provision, which is further down on the slide. You're going to have to pay back Medicaid. The trustee is going to have to pay back Medicaid when the person who has a disability dies. And so it doesn't make any sense to use third-party funds and contribute them to this type of trust, which then subjects it to the payback provision. Better would be to set up a third-party trust, which is not restricted by any payback provision, and that allows for a distribution of any remaining trust assets to other named beneficiaries, not the state Medicaid agency. And we've talked already about the sole benefit rule. With regard to the payback provision, also be careful in advising your clients regarding funeral expenses, because funeral expenses cannot be paid after death of the individual unless you end up having, after the payback, sufficient funds to allow for the payment of the funeral expenses. But if all of the money remaining in the trust is supposed to go to the Medicaid agency, you won't be able to say to the Medicaid agency, I need $10,000 to pay for this person's funeral. Can I do that first before I pay you back? The law doesn't allow that. Also, if you've got multiple states, people move around, they may have qualified for Medicaid in more than one jurisdiction. From a drafting standpoint, you've got to make sure that you draft a payback provision that applies not only in the state in which you're drafting for, but any other state Medicaid agency that may have provided benefits during the lifetime of the individual has to be covered by the payback provision. If you don't do that and you have a beneficiary who moves around, they may very well try to qualify for benefits in another state. Benefits may be denied on the basis that the payback provision is not sufficiently broad to cover a payback to other states besides the original home state. As far as why do we create the D4A trust, something to bear in mind is that the payback provision only applies to Medicaid. It doesn't apply to SSI benefits and certain other public benefits. So you could conceivably qualify for a variety of different government benefits, and upon the death of the individual, the only payback that is required is for Medicaid, so that could be of some benefit to the individual's estate. Also, the payback to Medicaid is based on the actual Medicaid expenditures as opposed to prevailing market cost of those services. So you've got a benefit by essentially buying the Medicaid rate instead of the private pay rate. There's no interest charged on the services rendered, so there could be services that were rendered years ago, decades ago, and they were rendered at a much lower cost than they would be today, and there's no interest charged. You do have to be aware also that some services are not covered under a Medicaid program, so the establishment of a D4A trust can be incredibly helpful to the individual who may need to access services that are not otherwise provided under Medicaid, and so these are some of your primary reasons why people create D4A trusts. Now, on the other hand, you have the pool trust, which is created and managed by a nonprofit organization. The individual is asked to sign a joinder agreement to the pool trust. There's a master trust and then a joinder agreement that's in place for each pool trust sub-account that is set up. As I said earlier, you can have a pool trust that is established by the individual directly, so that is of a benefit to the person who has a disability, and that's where we're trying to make the D4A language match the pool trust language. When you have a contribution to a pool trust, the nonprofit organization maintains separate accounts for the sole benefit of the individual, each individual who is joining and covered by a sub-account. The assets, however, are generally pooled for investment and management purposes, so you get the benefit of pooling of resources there. As far as payback goes, there is a payback, but there is provision under the law for the pool trust to retain funds in the trust after the disabled beneficiary dies. And to the extent that those funds are retained in the trust, those funds will not be subject to the payback requirement. However, if you are trying to set it up in such a way that you want any remaining funds after payback to go to other beneficiaries, then you must pay back the state first, and only then could you arrange for a distribution to other named beneficiaries. So that's the modified payback provision. To the extent that the funds are not retained in the trust, you are going to have to pay back Medicaid up to the amount of Medicaid expenditures through the date of death. This type of trust, similar to the D4A, has to be irrevocable. There isn't a hard and fast rule as there is in the D4A as far as the beneficiary. However, there are some states that take the position that a transfer into a pooled trust by an individual who is over the age of 65 will result in a Medicaid asset transfer. So you have to be familiar with how your state treats transfers of assets into pooled trusts by individuals over the age of 65. I happen to practice in 2 states which have divergent views. Florida does not penalize transfers to pooled trusts for over 65 individuals, but New York does. So you've got to be clear on the creation of these trusts for individuals who are over 65, because that could be an issue in your state. I mentioned NELA earlier. NELA is also working on a resolution of this issue with the Center for Medicare and Medicaid Services, trying to seek uniformity throughout the country so that transfers of assets to pooled trusts do not result in the imposition of a penalty period. If we're successful in doing that, it would be a tremendous benefit to all of us and to the clients whom we serve. You've always got to be careful about a Medicaid lien before you set up a supplemental, a D4A trust, or funnel any money into a pooled trust. The Medicaid lien is for services that may have been rendered prior to the receipt of funds and the establishment of the trust. And the lien itself can only apply to the medical services that are related to the injury that caused the award. So if there are other medical services that were paid for, not caused by the injury and the award, then those are not subject to the Medicaid lien. There are circumstances that allow for a negotiation of the lien, and they should be entered into in every case. To the extent that you can negotiate downward the amount of the lien, that's more money that can be placed into the trust prior to the funding, and more money that the person can rely on during his or her lifetime. Whatever the lien amount is determined to ultimately be, that has to be paid prior to the funding of the Supplemental Needs Trust. There was a Supreme Court case from 2006 called Alborn that you should be intimately familiar with. There was a more recent case, WOS, W-O-S, that reiterated the Alborn premise that the Medicaid lien can only be paid out of amounts that have been allocated to medical expenses as part of the settlement or the award, and any amounts that are non-medical in nature, such as pain and suffering, loss of companionship, etc., any other type of award is not available to satisfy the Medicaid lien. So the lien is limited just to the amounts allocated to medical expenses. We had a recent change in this area. The federal budget that was adopted on December 26th of last year contained a provision that legislatively overturned Alborn and said that starting on October 1st of 2014, the liens in these types of cases could be paid from all aspects of the award, whether it was limited to medical expenses or not. It didn't matter any longer, and that was a huge blow to the disability community. Well, the SGR bill, which has to do with doctors' fees under Medicare and which recently was passed by Congress and signed into law by the President 1st of 2014, actually delays the effective date by 2 years. So now we're looking at an effective date of this provision, October 1st of 2016, giving us some more time to lobby and advocate and hopefully reverse the provision that was included in the federal budget legislation that was passed last year. Okay, so that's all I'll say about the Medicaid lien. You also have to be cognizant of the fact that if Medicare is paying for medical services, there may be a Medicare lien. This is for coverage that's received prior to the settlement of the claim. You're going to want to contact the Center for Medicare and Medicaid Services to determine the amount of the lien, and you may have to consider a Medicare set-aside arrangement if it's appropriate for future expenses. That's something that CMS will let you know about, and you may have to include special provisions in your trust to make sure that the trustee is aware of the set-aside arrangement and make sure that there's enough funds in order to satisfy future Medicare liens on the assets in the trust. Okay, now, we've just covered first-party trust. We just covered pooled trust. We talked about Medicaid and Medicare liens. What happens if you have assets not of the individual but of a third party who is disabled? Well, so you've got a parent typically is what we'd be looking at, or it could be any other relative, and they could look at this situation and say, well, because my son or daughter has a disability and because I want him or her to qualify and continue to qualify for government benefits, I am going to disinherit that individual. That's one option. You could gift assets to the child with disability, which of course would have implications for their ongoing eligibility for government benefits. You could, some people distribute assets to a sibling of the person who's disabled, and some people set up supplemental needs trusts. My personal view is that the first three are not very, very good options. Totally disinheriting, gifting, distributing assets to a sibling, none of those really have the type of structure in place, the formal structure of allowing a trustee and the existence of the trust to dictate the parameters of how and when assets should be distributed and to assure that there will be ongoing government benefits eligibility. Really, the only way to do that is through the supplemental needs trust. So that's the best option. You want to do it, you'll improve the quality of life of the beneficiary. You want to stay away from any kind of language in these types of trusts that suggest that this is a support trust, because if you do that, you're not going to succeed in protecting the assets in the face of SSI and or Medicaid. The nice thing about a third-party trust is that there's no right of recovery by Medicaid, there's no payback, and you can set these kinds of trusts up either during your lifetime or through your estate planning documents through a revocable trust upon your death or through a will. This trust is created for the benefit of the individual with disabilities. You want to have language in there that says very clearly that it's designed to supplement, not supplant government benefits. That's the key language that the agencies look for. And again, no payback is required. What you can also do is when the individual for whose benefit the trust has been created, the person with the disability, dies, you can direct the corpus remaining at that time to go to any one or more individuals of your choosing. So it could be other children, it could be other family members, it could be charities. So it is a very nice way to assure the quality of life of the individual who has the disability during his or her lifetime, and then you can still provide for others. This type of trust is not described in any federal statute. There are some states that have third-party supplemental needs trust statutes. New York is one of them. APTL 7-1.12 is the citation for the New York statute. So you may have to look to state law for the establishment of these trusts, or you may have to look to your case law. They can be revocable, they can be irrevocable, they can be inter vivos, or they can be by will. Note that with regard to a D4A or a D4C, those have to be irrevocable, they can't be revocable, and they have to be inter vivos, they can't be testamentary. Okay, one question I want to address is whether or not there is some case law out there suggesting that the attorney has an obligation to create a supplemental needs trust as part of an estate plan. There's a couple of citations to cases where lawsuits were brought for the alleged failure to preserve government benefits through the use of a supplemental needs trust. So you've got the citations there, and I encourage you to pull those cases and take a look at it. I certainly think that we've come far enough and we're further enough along now that, for anybody who's contemplating estate planning and not incorporating disability planning in their estate planning documents, I think as time goes on, it's going to become more and more of an issue for an attorney who fails to take these issues into account. I've got a quote there from one of the cases. By contrast with the creation of the trust, Jamie will retain his Medicaid eligibility, and Saunders, the conservatrix, can provide for his supplemental needs from the trust assets, while Medicaid provides for basic medical care. Therefore, not only is the latter course of action clearly the better one for Jamie, it may be fairly stated that by failing to follow it, the probate court and Saunders potentially could have been deemed to be in dereliction of their duties to Jamie. Italics added. So you see that kind of language in the direction the courts may be going in terms of an obligation of the attorney to provide for this. As far as planning for married couples, it's Oftentimes the case that a married couple will come for estate planning, but they're also concerned about long-term care issues. In that case, you can provide for the creation of a testamentary supplemental needs trust in each of the spouse's will. You can't do it through a revocable trust. It has to be in the will. Be careful of right of election issues. If you're in a right of election state and you have to give a guaranteed minimum to a surviving spouse, it's conceivable that Medicaid could try to exercise the right of election on behalf of the surviving spouse if you didn't provide for the money to go outright. Florida happens to have the ability to set up a qualifying supplemental needs trust in full satisfaction of the elective share, so we're allowed to do that, but other states like New York don't allow you to do that, and it could be an issue. Finally, you want to include contingent supplemental needs trust language in your documents, which means that even if you don't know a beneficiary has a disability now, when you're drafting, you might want to provide for a contingent language, which says that when I die, if any beneficiary is disabled, I want to make sure that instead of getting the gift outright, I want it to go into a supplemental needs trust in accordance with Article 9 of my document or something along those lines. That'll be sure that no matter what, you're covered. Government benefits. You've got to be aware real quickly of the not means-tested government benefits, which is Social Security disability insurance. The standard there is unable to do any substantial gainful activity due to disability. And Medicare. These are not based upon your assets. They're not means-based government benefits. They're based upon whether or not you've paid into the system. The ones that we're most concerned about are Medicaid and SSI. There are others, but the two biggies are Medicaid and SSI. Those have resource and income limits, and in order to meet them, you're going to need a supplemental needs trust as part of your planning. With Medicaid, you've got to be careful because with limited state resources today, some of the services may not be available, so it may not be a full resolution to the issues that your clients may be facing, and that's where it's important to have a supplemental needs trust and have resources that can fill in the gaps. And you just got to become familiar with what is covered under Medicaid and what is not covered under Medicaid and what your client's specific circumstances are. Because if you're not, then you're not going to be able to give them the best advice about whether it's advisable to set up one of these trusts, or maybe they should go through the Affordable Care Act and get some kind of private insurance in place. That may end up being a better option. So you really have to wear a lot of hats and know what you're doing before you just run to the conclusion that supplemental needs trust is appropriate. Same thing with SSI. You've got a $2,000 resource level. You should be aware of the federal statute and the Program Operations Manual Systems, the POMs, that are the regulations that govern SSI rules. Be aware that there is currently a bill in Congress, the SSI Restoration Act of 2014, which would propose to raise the resource level from 2,000 to 10,000. That has not passed yet. Hopefully it will, because it hasn't been changed since 1972. With regard to SSI is designed to pay for food and shelter, which means that your trust probably should not be paying for those things. To the extent it does, you could have a reduction in benefits. The amount of the benefit can also receive a state supplement in addition to the amount that the federal government gives. As far as setting up the trust, just realize that food, shelter, and medical costs are those are three big things that a person has to be concerned about and paying for those kinds of needs. But look at all the other things that may come into play and which can be paid for through a supplemental needs trust. And that's how these kinds of trusts and the resources that are placed in them can be incredibly useful to our clients. All right, so that completes the overview of SNTs and government benefits, and I'm going to turn it over now to Ellen Morris to run you through some guardianship issues.
Good afternoon. So there are guardianships that do come up in the special needs trust arena. And in a D4A, a self-settled trust, we have a lot of elder law attorneys who shy away from going to court. However, if we have an individual who does not have any parents or grandparents who are still alive, we have no choice but to go to court and either have the court establish the special needs trust or have a guardian appointed so that the guardian may establish a special needs trust. In order to do so with a court, you have to do so via a petition. It's typically a brand new case number. You need to attach a copy of your proposed trust to your petition. Any judge will want to see what the proposed trust terms are going to be. for one of two reasons, either for themselves, the court themselves, to approve the creation of the trust, or to approve a guardian who then often, or most in Florida you do anyway, have to get court approval in order to go ahead and then engage in planning and self-settled supplemental needs trust planning. Regarding judges as to whether they want to be the creator of the trust, we in Florida had an issue with a few judges who didn't want to be the creator of the trust because they were afraid that by being the creator, they were going to be receiving correspondence and be somehow linked to the individual. That's actually not true, because as long as there's a designated representative who would be the trustee of the trust, and of course there's a separate tax ID number for these irrevocable inter vivos trusts, the judges are really not ever going to be involved. But that might be a hurdle for some judges to understand. We've been creative a little bit in the terminology that we used, where the judge can authorize the attorney to create the special needs trust or supplemental needs trust. So we've done it that way. The reason why we want to sometimes shy away from having a guardian appointed in order to create the supplemental needs trust is that then you have a guardianship opened, which has its own costs and ongoing judicial oversight involved, and ongoing oversight of the guardian as well. And so many states allow for basically a single transaction guardianship, where the guardianship is opened and closed and simply only opened for the purpose of having the guardian appointed and create the supplemental needs trust. So I would urge all elder law attorneys that are transactionally based and who shy away from going to court to get comfortable with going to court, to their probate guardianship court in this matter, because having the court create the trust or having a single transaction guardianship is much more preferable than having to actually have a guardian appointed that stays on. Along those lines, briefly, there are times when we do have to have a guardian involved. I'll give you a quick case study. A very well-known high-end bank is the trustee of a revocable trust for an individual who is now incapacitated, not determined so by a court of law, but de facto incapacitated by letters from doctors. And the trustee of this bank realized that there was only a certain amount of funds left, that the individual who is over the age of 65 does have quite a long lifespan ahead of them, being that their only physical or mental issue is of dementia and nothing severely physical. And so they realized that there is no durable power of attorney in place. There is no healthcare surrogate. They, as this corporate trustee, have been paying the bills of this individual, but they realize that the money is likely to run out, and that they want to preserve these assets so that there will be some funds to supplement what Medicaid may pay for down the road. And so their choices are, if the individual is under 65, to have a full-blown guardianship in place that can work together with the trustee and then create a self-settled supplemental needs trust, or in this situation, over 65. But we need a guardianship still in place to make residential decisions, health care decisions, and other decisions that a guardian would make, and the guardian can then work together with the pooled trust, in this case, since it's over 65. So there's another way, another case study as to why a simple revocable trust might then turn into a guardianship and a self-settled special needs trust or a pooled trust. The D4B trust is an interesting concept when it comes to guardianship, because if we are in a situation where there is no power of attorney and no spouse, we may need to seek court approval of creating the D4B supplemental needs trust. Again, a guardianship is not needed per se, but a petition and a copy of the trust have to be in place so that we can we have some way of having the D4B trust established. If a guardianship is already in place, under Florida law anyway, the guardian must seek court approval in order to engage in Medicaid planning, which would include the D4B trust. So the court's going to want to know what's happening with the income, what we need to do with the D4B trust, and be involved as to the extent to make sure that the ward is still being taken care of. As far as the D4C pool trust situation, a great scenario is the one that I just mentioned, where we do need to seek approval in a guardianship context if we have no one else, no family member trustee, no power of attorney, etc. And we want to do Medicaid planning because we know that the money is going to run out. And in that case, we would have to use, especially over 65, of course, we have to use the pool trust, the D4C trust, because it's the only thing available that will preserve assets to supplement what Medicaid is going to pay for. So if the person really is used to having their own individual aid, Medicaid is not going to cover that, but money put into a pool trust obviously can be used for that. If the person is really a private person or doesn't get along well with other people, Medicaid is only going to pay for a semi-private room, so putting money in a D4C pool trust in a guardianship is going to allow that person, if they have to move out of their home and into a facility, to be in a private room. We do need to seek court approval, though, when we're talking about an incapacity and no one acting under advance directives. Last slide regarding guardianship has to do with reforming typical estate planning documents, as Howie went into, that don't include contingent supplemental needs trust planning, whether it's in their revocable trust, whether it's an irrevocable trust, a will, or otherwise. We often go to court to reform an estate planning document when a beneficiary is a supplemental needs person, or very well likely will be a supplemental needs person in the future, and they've been diagnosed with something that is a debilitating illness. We want to go in and reform those trusts. We want to obviously have cooperation by all the beneficiaries and the trustees involved. And even if it's an irrevocable trust, we want to do that. Courts, the public policy lend courts to take these petitions as very well received reformation petitions, because, especially if all the beneficiaries are in line, they are preserving the assets for that beneficiary as they were meant to be preserved. And it's a win-win situation by preserving assets and providing for contingent beneficiaries instead of the payback provision in the self-settled trust, and still adhering to the intent of the individual, meaning had they been advised that there was a possible special needs trust option in their revocable trust or their irrevocable trust, and that there was a possibility that one of their children or grandchildren might need that type of, they would have done that. So I'm going to now turn this over to our next speaker, and she's going to talk about tax issues.
Thank you. Thank you. I don't know if I can be heard, but my phone just all of a sudden made some noises. Anyway, I'm sure you've already guessed that Ellen, Howie, and I drew straws, and I got the short one. So I'm talking about taxation of special needs trusts. I'm not sure how I get control of the slides, but I don't seem to be able to get control of them to switch them. So if the moderators could switch the slides for me, that would be great. The reason I'm fine with speaking about taxation of special needs trusts is that's something that other lawyers ask me about all the time, and, of course, the clients ask me about the taxes, too. Usually, when I have a client reviewing a third-party special needs trust that I've drafted, they read the grant for trust language and they don't understand why. I'm going to start out by reviewing the basics of the trust taxation rules. I keep a cheat sheet of these rules handy so I can refresh my recollection before I speak with my clients about my trusts, because I know that they're probably going to ask me about them. I'm not going to review what makes a trust a grantor trust because this is supposed to be a course for non-beginners, and I'm assuming everybody here already knows what makes a trust a grantor trust. So first, let's talk about the grantor trust taxation rules, and this is so important to our clients because for income tax purposes, all items of income, deductions, and credits are not taxed at the trust level, but they're reported on the personal income tax return of the individual who's considered the grantor of the trust. For non-grantor trusts, distributions for the benefit of the beneficiary carry out income in that beneficiary. Usually, this is ideal because the beneficiary, and in terms of special needs trust planning, our beneficiaries earn little or no income, so the beneficiary is in a low income tax bracket. The beneficiary often will have his or her own personal exemption, and in a lot of our cases, the standard deduction for individual taxpayers will be available. So unless the beneficiary has other sources of taxable income, the only trust income taxable to the beneficiary will be the income that exceeds the total of the beneficiary's standard deduction and personal exemption. Remember that retained income that's not distributed to or expended on behalf of the beneficiary is taxed to the trust. Now let's look at the tax brackets. Trusts have highly compressed tax brackets. For 2013, trusts reached the highest federal tax bracket of 39.6%, a taxable income in excess of $11,960. But for a single taxpayer, the tax rate on taxable income of $11,960 is only 15%. That's a huge difference. The highest federal tax bracket of 39.6% doesn't even apply to an individual taxpayer until taxable income reaches over $400,000. Further, the exemption on trusts is only $100. This is what's called a complex trust exemption. A caveat I put in my outline is that if the trust requires all income be distributed on an annual basis, the exemption is then only $300. But remember that SNTs shouldn't have a requirement that all income be distributed out on an annual basis. But I didn't want people to get confused. Remember that the personal exemption for 2013 is $3,900. There's another type of a trust that allows a larger exemption, and that's a qualified disability trust. A qualified disability trust is a non-grantor trust. It's established solely for the benefit of an individual under 65 years of age who is determined to be disabled by the Social Security Administration. When I first learned about qualified disability trusts, I thought they were great. This is because not only does the trust get the personal exemption, but of course the SNT beneficiary also gets his or her personal exemption. So for 2013, that would be $3,900 times 2, or $7,800. I think that's fantastic. I wrote an article about these trusts and used the lure of the size of the exemption as another reason why my special needs parents should name an institutional or professional trustee rather than a family member. In other words, the qualified disability trust is complicated and requires a professional in order to ensure the two exemptions are claimed properly. In most cases, it works. I think it works because whenever I hear the word tax, my brain simply shuts down and I can't deal. It's the same for our clients. When you start talking about taxation of trusts, their brains simply shut down too. To make matters worse, I get excited about things like qualified disability trusts, so they really tune me out. A quick update for qualified disability trusts. Certain qualified disability trusts will be subject to a phase-out, which is too bad. But for 2013, all qualified disability trusts with modified adjusted gross income in excess of $250,000 are subject to a phase-out of the personal exemption deduction. I included the notice on my slide from the IRS webpage. I also included in the slide that the trustee should file a Form 56 with or before the first Special Needs Trust tax return is filed. It's just part of my routine now in my practice, but I wasn't sure if people knew that or not, so I included it in the slide. The next slide that's up needs some clarification because I didn't notice that the slide left off net investment income tax. Sorry about that. So let's go over the Affordable Care Act quickly. There's actually two separate new taxes associated with the Affordable Care Act, or as some people call it, Obamacare. Net investment income tax, this is the 3.8% on net investment income in excess of the modified adjusted gross income of the threshold amounts, and that's $250,000 for married filing jointly and qualified widow. That's $125,000 for married filing single, and then $200,000 for head of household and single. The second one is the Medicare tax, which is 0.9% of wages and self-employment income in excess of the $250,000 for married filing joint, $125,000 for married filing single, and $200,000 for all others. The wages used here are gross wages, or what they call Medicare wages. The tax begins January 1, 2013. The reason for the slide mix-up is that the Medicare surtax also applies to estates and trusts once the taxable income reaches the top marginal tax rate. So some SNTs will end up with income subject to this new tax. Remember, individuals will be subject to the new tax only if they receive passive income during the tax year in which their modified adjusted income exceeds certain thresholds. When an individual's modified adjusted gross income exceeds the applicable threshold and the individual received passive income during the year, the Medicare surtax will be assessed against the lesser of the taxpayer's net investment income or the amount by which the taxpayer's modified adjusted gross income exceeds the applicable threshold above. Confusing? Yes, definitely. Your accountant should be able to answer any questions about this Affordable Care Act better than me. But remember that we're attorneys because we don't want to do numbers. Well, at least I can't. Okay, moving on to income taxation of self-settled special needs trusts. Self-settled special needs trusts are considered grantor trusts. This is under the Internal Revenue Code sections 671 through 679 for those of you inclined to look it up. It allows the trust income to be taxed to the beneficiary and not at the standard federal rate for trusts. In self-settled special needs trusts, the grantor is the source of the trust assets. And as a grantor trust, the self-settled special needs trust is basically ignored for income tax purposes, and the grantor is treated as having received the income directly, even though the trust receives the income. When I explain this to my clients, I usually tell them that all income from the self-settled special needs trust will be taxed directly to the beneficiary. And that's really all they need to know, is that the grantor trusts only need to file information or fiduciary income tax returns, the 1041s. The fiduciary income tax return lets the IRS know that the income will be reported on the grantor's personal income tax return. Again, this is normally beneficial because the beneficiary will usually be in a much lower tax bracket and pay less tax than the trust would. Now we're going to go over briefly third-party special needs trusts. A third-party special needs trust that is revocable is treated as a grantor trust with all income tax to the grantor. A non-grantor trust pays income tax at the trust level on any taxable income retained by the trust. If a trust makes a distribution to a beneficiary, the distribution will pass the taxable ordinary income. It will pass the taxable ordinary income, but generally not capital gains, to the beneficiary to be taxed on the beneficiary's personal income tax return. In that instance, the trustee must complete Form 1041 and issue a Schedule K-1 to the beneficiary, showing the amount and type of income from the trust to be included on the beneficiary's individual tax return. And again, briefly, is the Qualified Disability Trust status. A third-party special needs trust may qualify as a qualified disability trust for income tax purposes. And this was, as some background, this was set up in 2001 when Congress created Internal Revenue Code Section 642B2C, and it established a tax benefit for certain disabled individuals who are beneficiaries of special needs trusts. The Qualified Disability Trust must have certain statutory requirements. First, the trust must be irrevocable. Second, the trust must be for the sole benefit of the beneficiary. Third, the trust itself cannot be a grantor trust, so it won't work for self-settled special needs trusts. It must be a separate tax-paying entity. The beneficiary must be under the age of 65 at the time the trust is established, and the beneficiary must have a disability determination from the Social Security Administration. As I said before, a qualified disability trust is eligible for a deduction equal to the personal exemption in lieu of the $100 complex trust exemption. And again, the personal exemption for 2013 is $3,900. So if the third-party special needs trust cannot meet the requirements of a qualified disability trust, then it's simply taxed as a complex trust and receives the significantly lower exemption, just the $100. At this time, I'm going to talk about briefly one of the things that I see other attorneys do in drafting special needs trusts that's a mistake. A self-settled special needs trust that provides the beneficiary with a testamentary power of appointment over the property remaining in the special needs trust at the beneficiary's death and after the payback is satisfied does not result in a completed gift upon the funding of an irrevocable special needs trust with the beneficiary's asset. This is true even if the beneficiary is not capable of exercising the power of appointment. I get that a lot from my colleagues when they say, well, the beneficiary can't possibly exercise this. It's the mere possession of the power, if it's insufficient to preclude a completed gift upon funding. So it's the mere possession of the power that's insufficient to preclude the completed gift upon funding. Just don't do it. The beneficiary does not have a testamentary special power of appointment over the remainder interest upon death. This is also a mistake in third-party special needs trusts. Gifts to third-party special needs trusts will not qualify as a present interest with respect to the beneficiary under IRC Section 2503B. Giving the beneficiary these crummy rights of withdrawal will impact the beneficiary's means-based benefits. If you're inclined to mix gift tax planning with special needs planning, adding a secondary permissible beneficiary to the third-party special needs trust will allow the secondary permissible beneficiary certain withdrawal rights under the estate of Cristofani versus Commissioner 97, Tax Code 74 from 1991. So in terms of drafting special needs trusts, only Cristofani powers will work. Crummy powers will mess up the special needs beneficiary's benefits. And I have to say, I never really mix gift tax planning with special needs trusts. I'm not sure what Howie or Ellen do, and I'd be curious to hear what they do in special needs trusts with Cristofani powers. If I have clients with special needs beneficiaries and taxable estates, there are usually plenty of other things that we can do for these clients that don't involve the special needs beneficiary. I only have a few more minutes left, and so I'm not going to be able to go over everything, but I did want to mention that some of the things that conventional estate planning attorneys get confused about is the word income. That is, income for tax purposes is different than income for Social Security purposes. For example, income for supplemental security income, or what we call SSI, means food, shelter, or cash were paid from the trust and received by the beneficiary. It doesn't include the paper income reportable to the IRS. I'm not going to have time to go over the estate tax issues, but there were a few things that I wanted to briefly mention. Present value. So if you've got guaranteed annuity payments going to a self-settled special needs trust, these will be fully includable in the beneficiary's gross estate. The beneficiary's estate is also entitled to an estate tax deduction for the payback amount, and then a stepped-up basis is available for assets remaining in a self-settled special needs trust at the death of the beneficiary under Internal Revenue Code Section 1014B9, minimizing the capital gains tax payable upon the sale of the assets that satisfy the payback interest for Medicaid. Irrevocable life insurance trusts are usually created for our clients with large estates subject to the estate tax, but these have to be properly drafted. So don't make a common error when the trust is drafted and include the crummy powers and the powers of appointment. Now we're going to turn the talk over to drafting considerations and pitfalls to avoid, and I'm turning this back over to Howie and Ellen and myself to go over these things. Thank you.
All right. So drafting considerations. One of the things that I like to do in drafting supplemental needs trust, whether it be a first-party or a third-party trust, is the inclusion of the appointment of a trust protector. And I'll share with you an example of where that turned out to be a very useful thing. I had a client for whom we did a D4A. There was no parent or grandparent. We had to go to court to seek an order of the court to create the trust. We did that. This was back in 2010, and there was some language in the trust that was fine at the time. Subsequently, around 2012, 2013, there were some changes in the way the Social Security Administration viewed payments for non-beneficiary travel, meaning that you might have family members who want to come out and travel and spend time with the beneficiary, and whether or not trust funds could be used in furtherance of those types of payments, and whether those payments violate this sole benefit rule because a third party's expenses, in essence, are being paid, not direct expenses of the beneficiary, although the argument on the other side is that the beneficiary is benefiting from this type of expenditure because it allows a family member to check in on the beneficiary, make sure things are going okay with plan of care, talk to caregivers, and so on. And so we were very upset when these changes came about. Well, the trust that I had done in 2010 had very liberal language pertaining to the use of trust funds in furtherance of payments that could be made to family caregivers and travel arrangements and travel expenses. And the Social Security Administration, although I had submitted the trust for approval years earlier, they didn't get around to looking at the trust until sometime in 2013. Now, the client for whom this trust was being prepared was a recluse, and she never left her apartment. She's fearful of everything and has a lot of anxiety over things that the rest of us may take for granted. Well, when she got a letter from the Social Security Administration telling her that her trust was not acceptable and that her SSI payments were being discontinued, it didn't take her very long to call my office in a very anxious state, wanting to know what I was going to do about this and how come I drafted a defective trust. What was helpful is the fact that we had a trust protector in place, and that trust protector was authorized to amend the trust as necessary in order to take into account any changes in the government benefits rules and regulations this is exactly what happened. I was able to strike the now offensive language in the trust and send it over to the Social Security Administration, which then passed muster. So I'd encourage you to consider the use of a trust protector for that reason. I'd also encourage you to find a way to make sure that you're staying on top of changes in the law. You've got to attend webinars like these. There are organizations around the country that devote themselves exclusively to special needs planning. You should look at those organizations and consider attending some live programs and events to make sure that you're staying abreast of changes in the law, because had you not, you may not have understood why your trust was being rejected due to the issuance of the new POMs in this area. Elizabeth, you want to say anything about that?
Well, Virginia just passed the decanting statute, and I've used that on a number of occasions to fix things like you just described with your clients by decanting to a new special needs trust that includes provisions that are not abhorrent to Social Security. And that's another way of dealing with that issue if you don't want to do trust protectors.
And you've got to obviously be familiar with the state's decanting law if there is one. Also, what are the parameters? What are the requirements before the decanting provisions will be triggered? Can you get tripped up on any of those, which would preclude the decanting from occurring? So you got to decide how you're going to approach this. But even though these trusts are irrevocable, there are some mechanisms that allow you to still amend the trust after the fact, not by the individual who's the beneficiary of the trust, but it could involve a trust protector. It could involve decanting. It may involve going back to the court and saying to the court, I have a problem I need you to resolve, and I want to amend the trust. So there are ways to do it, but you've got to decide which way you think you want to strategically go with your trusts so that you have some mechanism for dealing with these kinds of changes in circumstances. Okay. Another drafting consideration is the question of defining, by way of what we call a laundry list, all of the different things that constitute special needs. You could have a list that goes on for several pages in your trust that explains that all of these things are considered to be special needs and therefore appropriate use of monies from the trust, so that you make sure that there is no question on the part of the trustee or any other family member or any other third party as to whether it's appropriate to use trust funds in furtherance of this laundry list of items. There's two sides to this argument. One is the longer the list, the clearer you're being in the drafting of the trust as to what is appropriate and what is not appropriate. But the longer the list, the flip side of that is if there's an item that wasn't included in the list, does that suggest by its omittance you intended that it not be an appropriate use of trust funds? So for that reason, some practitioners prefer to draft a more general statement of the fact that the money in the trust is to be used for items of quote-unquote special needs and as determined by the trustee. So as long as it doesn't infringe on government benefits, really anything could be game under that approach. And that gets you out of the whole question of whether, if you included a laundry list, did you really make it exclusive, or was that not your intent? Elizabeth, any thoughts, or Ellen on that?
I just wanted to mention that you, as a practitioner, you have to be aware of the connection between the beneficiary's abilities and whether or not, when you're drafting the trust, you're precluding the trustee from removing the beneficiary from eligibility for public benefits to the means-based public benefits or not, and how tight you want to have that ability for the trustee to use the funds for anything or to bump the person off of public benefits. And I see a lot of people do trusts when the person may be able to hold a job and not need public benefits just because they heard that's what you're supposed to do with a special needs trust. So a lot of that depends on your state rules, but I'm not sure what you do.
Well, I think you bring up a good point because, you shouldn't rush to conclude that the Supplemental Needs Trust is the appropriate way to go. You may decide after careful analysis that the services that are available through government benefits are not so great, and you might be better off through a variety of different other resources and through private pay to put your beneficiary in a better place in terms of accessing services and quality of services and things like that. Another thing that you mentioned is, suppose you already have a trust in place, what is the trustee's ability to use money from the trust even if it will reduce government benefits? We usually include a clause in our trust that allows the trustee the flexibility to do that, assuming that the trustees determine that the beneficiary will be better off, notwithstanding the subsequent reduction in government benefits, through the expenditure of trust monies for items that would otherwise be paid for by government benefits, and the subsequent reduction notwithstanding, they're still better off spending the money in furtherance of that item. So that gives the trustee the flexibility to spend or not spend in the best interest of the beneficiary.
Another drafting consideration in the guardianship context, when you're drafting your petition to get court approval, either for a self-settled supplemental needs trust or to engage in pooled trust planning, is to make sure that you include a cost basis benefit analysis for the judge to say, look, here's what a care manager or a physical therapist or an occupational therapist or the combination of all of them, a sort of a larger care plan, project the cost of care for this individual to be over their expected life expectancy. I include that a lot in my petitions. Judge, this is why we want to engage in this government benefit planning. This is why we believe that it's beneficial to get government benefits and preserve some of these assets because of this, projected cost analysis for the future. So as a drafting tip, keep that in mind.
I think that's a great tip because the judges, I find, really appreciate when you show them why it's necessary to do this. And I noticed that some attorneys that don't explain this to some judges, and they just don't understand special needs planning, and so I think that's a really good tip.
Any other drafting tips?
I just have one more that I'm asked a lot by other attorneys. If the elder person has a spouse and they have revocable living trusts, remember that the beneficiary of the special needs trust will only be disregarded as an available resource to that spouse if it's created under the terms of the settlor's will and not pursuant to a will substitute such as a revocable living trust. I get that a lot from people, so make sure you're not making that mistake thinking that with my revocable living trust I can leave 1/3 to my spouse. In Virginia we can leave simply the 1/3 marital share to the spouse, and it will suffice. Other states have other rules about that. But and I don't know if you come up with that a lot too, Howie or Ellen, but I seem to get that question quite a bit.
Well, it's funny. That's something that I struggle with, and Howie and I struggle with in our practice as far as drafting because of the private letter ruling which came out in the bankruptcy context, which said that in states where there is a right of election, that right of election is personal to the spouse or the spouse's personal representative. And for instance, a bankruptcy trustee was unable to assert the right of election on behalf of creditors in that context. And in our state, in Florida, we have never had the state of Florida or our Agency for Healthcare Administration either deem the failure to provide for an elective share trust for a spouse to be a transfer of assets penalty, nor have we had the state try and assert the right of election on behalf of the institutionalized spouse. And if they did that, I think clearly they would not have the right to do that since it is a personal right but they could treat it as a transfer of assets penalty. Hey, Mr. Spouse, you gave all your money to your kids. You did not create a spousal supplemental needs trust for your wife who's on benefits, and so we're treating that as a transfer of assets, and we are bouncing, mom off of benefits. We've not had either of those happen in Florida.
Oh.
That is not to say that it can't happen, but it's always a conundrum of, putting some money aside and causing a delay to the beneficiaries or not. And seeing if Florida is ever going to take that position.
Right, and the reason why we have an internal dialogue about this issue is that because I also practice in New York, where the New York Medicaid agency has gone on behalf of a surviving spouse and forced the exercise of the right of election, I'm a little bit more leery of not providing for the creation of the Supplemental Needs Trust in satisfaction of the elective share, particularly since Florida law specifically condones that. And so I like to take advantage of it. And on the point you were raising, Elizabeth, about it has to be done through a will, I just met with a client this morning who is doing a revocable trust and a pour-over will. But, of course, with respect to satisfying the elective share, I had to pour back from the revocable trust, the husband's revocable trust, into his estate 30%, which is our elective share amount, through his probate estate, through his will, and pursuant to the will is where the Supplemental Needs Trust for the benefit of the surviving spouse, that's where all that language is. And he was asking me the question, well, I thought if I do a revocable trust, part of the reason to do it is to avoid probate. So now you're telling me I can't. I said, well, yeah, if your wife survives you, and in fact that provision is triggered, we would have to do a probate with respect to the 30%. That's the only way it will work. If your wife predeceases you and you're only going to give assets to your kids upon your death, you can set up a supplemental needs trust for the benefit of the kids to the extent anyone would, need one if they were ill or disabled, and that can be done through your revocable trust, but it can't be done through the revocable trust for the benefit of the surviving spouse.
Mm-hmm. And in Virginia, we have the elective share issue as well with our Medicaid offices. So,
what do they do, treat it as a transfer of assets?
They do. They treat it as a transfer of assets. So we do the pour back trusts as well.
Let me share a tip, if I could, for people who are providing services in relation to drafting of the trust. Assuming you've determined that a trust is appropriate and you've done it and it's being funded, that's not the end of the representation. We have beneficiaries and trustees who come back to us, and they need to understand how the trust works, how to properly administer it. They're not expert in the area of government benefits rules and regulations and what distributions from the trust are appropriate or inappropriate. So you're going to want to try to talk to your trustees once the trust is set up and let them know about these challenges that lie ahead. You probably ought to have some kind of a letter that goes out with some parameters on the use of trust monies, so that you can give them some guidance, but even that will not be the end of it. You may want to implement some kind of a program through your law firm that allows them to put you on a retainer to deal with these kinds of ongoing issues for the administration of the trust and make sure that the benefits are kept in place and there are no violations.
Do you encourage your clients not to name a family member as the trustee, Hallie?
No, not necessarily. If we feel that the family member is an appropriate person, I don't know if I can tell you what is the definition of an appropriate person, but it's one of those things where you know when it's inappropriate. Oftentimes, if you see a resentment amongst siblings, then you want to raise the question with your client, are you sure you want to appoint that person as the trustee, because they obviously harbor a lot of resentment over time, and that usually stems from if parents have given a lot of attention to the child who has a disability, and the child who does not have a disability may feel like a lot of time and attention was robbed of that from their parents. So they harbor resentment towards the child who has the disability. They may not be the best person to administer and be trustee of a supplemental needs trust. So that really goes to how do you interview and screen the family, and when you set up these trusts, It goes beyond the drafting part of the trust. There's so much that transcends drafting of these trusts that comprises a special needs planning practice that you really have to be familiar with.
I'm just going to add one thing, and I know we're going to move on to the question and answer session, but the other thing to consider is the inherent conflict of interest of naming a family member like a sibling, because if it's a third-party special needs trust and they are going to benefit by inheriting upon the death of the special needs trust beneficiary, that does create a conflict of interest. And I've had a number of those situations, and I had to explain to the trustee sibling, who is also the contingent beneficiary, this is not about saving money for you. This is about doing the right thing as trustee. So that's one reason to use a corporate special needs trustee rather than a family member, for sure.
Right, and of course the flip side to that is how much money are we dealing with, and can you get a corporate trustee to serve depending on the amount of assets in the trust?
Yeah, that's true. That's true.
Okay, I know we're going to the question and answer session, so we'll let the moderator do that.
Thank you, Elizabeth, Howard, and Ellen, for your insights today. Before we start our live and interactive question and answer session, a brief announcement. Many states require that you record and report the following code in order to obtain CLE credits for the live or recorded version of this CLE webinar. If you will be requesting CLE credits for this webinar, please write this code down on your attendance form. The code is TFAEDB. That's T like Tango, F like Foxtrot, A like Alpha, E like Echo, D like Delta, B like Bravo. Again, that's TFAEDB. You will receive an email with a link to the CLE form at the conclusion of the program. Now on to our live question and answer session. Listeners can ask our speakers questions relevant to today's topic by either emailing questions to legalquestion@stratfordpub.com or submitting questions by typing your question into the Q&A box at the bottom left corner of the screen and click Send. You may also ask questions by telephone. To do so, simply press *1 on your touch-tone phone. Again, that's *1. If for any reason you decide not to ask your question, you can press *1 again to exit the question queue. After you press *1 and when it's your turn, the operator will announce the first name and city for the person registered for your location. If you'd like to identify yourself further, please do so. So our first question is, in the third-party special needs trusts, what are the issues in drafting for the person or married couples? In other words, when the person or married couple sets up a special need trust for himself or themselves.
I'm not sure that I understand the question.
If it's a third-party special needs trust, then the person is not setting it up for himself or herself.
Yeah. It would be a self-settled or first-party special needs trust if you're setting it up for yourself.
And it's an individual, so the only time the married spouse has anything to do with it is, like we discussed, the spousal supplemental needs trusts that are contained under a will. So if you want to press *1 and ask us your question over the phone or expand on that, we're happy to answer.
Okay, we do have a caller with a question. We would like to patch that in right now.
Okay.
Alexander, go ahead.
Yes, I think it's the same question that we've had. I live in Tennessee, and I've got a wife whose husband's got dementia, and she wants to set up a special needs trust for him. As I understand the law, she would have to enter a will, just pay her estate, pay the trust back into her estate, and then so that the money all passes through her estate, and then they would set up the special needs trust in the will, and that means that the husband would have descent rights as to the entire amount. Is that the way it's done? Do you have to run it through the estate? Is that what you have to do?
Yes. You have to do it through your will.
Right. You can do 30% elective share, or you can do the whole thing. But yes, you have to do it through your will, and many states have a threshold requirement for getting court approval. Ours is $100,000, so anything over $100,000, you need actually court approval in order to establish the spousal supplemental needs trust. So take a look at Tennessee and make sure what that threshold is. But yes, through the will.
So it wouldn't be, you couldn't like pour it into a revocable trust? In other words, the wife's will couldn't just pour into a revocable trust. Would that bypass his dissent rights?
It could pour it into a revocable trust, but if he survives her and he's a supplemental needs person, it would have to pour back into a trust contained under the will, and that would be a probate.
Okay, so it does have to go through the estate.
Yes.
Okay, thank you.
Our next question on reformation. If I understand correctly, a person can petition the court to reform a will or trust to create a special needs trust for a now disabled devisee beneficiary who would otherwise, under the terms of the will or trust, take his or her share outright and free of trust. Is that correct?
Yes.
Yes.
One thing to add to that, though, is you're going to want to be familiar with not only your state case law, but if your state is divided up into judicial districts, your local judicial district where you're practicing, if there are any nuances or any sets of circumstances that dictate whether and when relief will be granted in this regard and when it will not, obviously you want to be familiar with that. But conceptually and generally speaking, if you have a situation where you have somebody who's not planned properly, they have not provided for the creation of a supplemental needs trust on their death, and you have a beneficiary who's disabled, the proper recourse is to seek reformation of either the trust or the will in court in order to have the necessary language basically written in after the fact and adopted and approved by the court so that it operates exactly like a supplemental needs trust.
And, the reason why you want to do that, rather than just having them inherit the money outright and then creating their own self-settled supplemental needs trust, is because you avoid the payback again. So there's no reason not to avoid the payback by doing the reformation prior to the money being distributed outright.
Okay, we have another question. Could you please quickly explain the difference between leaving funds from a revocable living trust or will regarding the disregarding of resources? I didn't understand that.
All right, I think the only distinction between the revocable trust and the will has to do with a limited circumstance of trying to set up a supplemental needs trust for the benefit of a surviving spouse. So if the beneficiary is to be a surviving spouse and you're trying to protect those assets from government benefits being counted towards government benefits eligibility, then if you have a married couple, the only way that you can provide for that type of planning is through the use of a will. If you are using revocable trusts as part of your estate plan for a married couple, and you still want to be able to set up a supplemental needs trust for the benefit of the surviving spouse, what you will need to do is essentially a reverse pour-over of the amount that you want to go into the supplemental needs trust. It's going to go from the revocable trust through the probate estate, and the will of the decedent will then create the supplemental needs trust. That's how you comply with federal law on this issue. If that doesn't answer your question, let us know and I'll clarify further.
Thank you. Next question. Can a party establish a special needs trust for himself, wait the 5-year look-back period, and then qualify for Medicaid? If so, can the income and principal of the special needs trust set up for the parent be also distributed to other beneficiaries in addition to the parent?
Well, so there's a couple of things going on here. First of all, the 5-year look-back period, while it applies in every case where there's an application for benefits, one of the purposes of using these so-called exception trusts is that there is no penalty period for the creation and funding of the trust. So as long as you are an appropriate person to be using a self-settled trust, which means you're under age 65, you can transfer the assets into the trust, and the 5-year look-back period, while it applies, it won't preclude your eligibility. There's no penalty period upon your funding of the trust. So you can do that and qualify for Medicaid immediately thereafter. Then the next part of the question has to do with naming other people to be beneficiaries. In a self-settled trust situation, there is a payback requirement. You have to first make sure that Medicaid is fully paid back. After that, could you provide for others? Yes, you can. You just can't provide for others before Medicaid is paid back.
I'm not sure that we understand that second part of that question, though, regarding the parent. Elizabeth, do you want to take a stab at that? I'm not sure that
I'm not sure I understand that question either. But a special needs trust, there can only be one beneficiary, really. I guess I don't understand the question.
Yeah, for sure during lifetime. I was trying to suggest if after the beneficiary died and you had a full payback to Medicaid, at that point could you provide for others? And I think the answer to that is yes, you can. But during lifetime, no, you cannot.
Okay. Our next question, please provide a sample trust protector for a third-party special needs trust.
Well, it's not really a question. It's a request for a sample document.
Okay. Well, then let's move on. We've got a lot of questions here to go. What standard contingent special needs trust provisions would you recommend for the surviving spouse specifically, if any?
So, and I'll try to take a stab at that. The essence of the language says that if you might provide an outright distribution to the surviving spouse. The contingency provision would be something along the lines of, if, however, my spouse is ill or disabled and is receiving or applying for government benefits at the time of my death, then I do not want the money to go outright to her. Instead, I want them to go in accordance with Article 9, let's say, of my will, which provides for the funds to be held in further trust in accordance with further provisions that follow in Article 9, and those provisions are your supplemental needs trust provisions. That would be the essence of a contingent supplemental needs trust provision.
Okay. Next question. Is there a suggested estate value to consider the qualified disability trust given the ACA tax complexity?
Elizabeth, do you want to tackle that?
Sure. Well, because of the phase-out, it would have to be a trust under the value of $250 in the modified income bracket. I don't know why they're doing that with the phase-out, but it would negate any of the taxes. I doubt that a trust with less than $250,000 would make that sound that you would need both the individual and the qualified disability trust exemption amounts. Do you guys have any comments on that?
No.
Okay. Let's move on. For those clients who do not have any special needs trust issues, does the trust tax rate of over 39% versus the 15% rate explained earlier negate any reason for the establishment of a trust?
Well, to avoid probate, all the regular reasons to do a grantor's trust, I guess I don't understand the question. The 39% has to do with the complex trust issues.
The 15% was just an example of a lower individual tax rate versus the highest tax rate that might have to be paid under a trust, an irrevocable trust situation. But as far as negating the reason for the establishment of a trust, it would always be best, especially with the tax considerations that Elizabeth talked about, to create a special needs trust in your document as a contingency for a third party, let's say revocable trust or under a testamentary trust under a will, as far as savings to the individual who is disabled, because it's always going to be better to get those benefits.
Okay, thank you. Setting up a spousal special needs trust through will, is this only applicable to elective share states, or does it also apply in community property states?
So I think I can answer half of the first part of the question, which is it's not necessarily limited to elective share states. In states that don't have elective share statutes, and even in states that do, you can decide that you want to set up a supplemental needs trust for the benefit of the surviving spouse simply because you want to provide for the flexibility that the surviving spouse will be able to qualify for government benefits after you pass away, and so as to render those assets non-countable. The elective share part of it only goes to the minimum amount that you would have to fund such a supplemental needs trust in order to satisfy the elective share. But even on that issue, you have to have a state statute like Florida's, which says that if you create a supplemental needs trust in the amount of the elective share, instead of the money going outright to the surviving spouse, that will be deemed to be a full satisfaction of the elective share under our state law. If you don't have that type of provision on the books, you could have a state like New York where there is an elective share in New York. It's 33 1/3%, not 30% as is the case with Florida. But New York does not have a provision on its books which says that the creation of a supplemental needs trust will satisfy the elective share, which means if you have a will in New York that purports to funnel the money into a supplemental needs trust for the benefit of the surviving spouse in the equivalent amount of 33 1/3%, which is designed to equal the elective share amount, that's not a valid satisfaction of the elective share in New York, which the statute requires an outright distribution. So you could, even in that circumstance, if that's what you had in your will, you could have Medicaid come forward and say, you have to give that 33 1/3% outright. You didn't do it, and we're going to object to the estate plan being carried out as the will would try to have it carried out, and they would be successful. So in that case, 33 1/3% would have to go outright to the surviving spouse. Now you have an over-resourced surviving spouse who may already be on government benefits and may have to do some planning midstream. And maybe go off benefits for a while, try to do some planning to protect some of the money, and then go back on benefits. The other thing is you could put, instead of the elective share amount, any amount into a supplemental needs trust. If you're in a non-elective share state and a non-community property state, because I'm not in a community property state and I won't speak to those issues, you could put 10% of the estate for the benefit of the surviving spouse. You could put 100% of the marital estate for the benefit of the surviving spouse. So you're not married to the elective share amount.
Okay, thank you. Do assets foregone via a qualified disclaimer count as a transfer by the disclaiming person for purposes of government benefits qualification tests? For example, husband's will leaves X amount of dollars to the surviving spouse with her right to disclaim that gift, in which case that gift will instead pass to a testamentary special needs trust for the benefit of the surviving spouse. If the surviving spouse disclaims, is that a transfer?
Elizabeth, you want to take that one? They kind of combined spousal and disclaimers.
Yeah, I would say yes, that a disclaimer is a transfer. I don't know how to...
It's hard to answer the second part of your question. A disclaimer is a transfer, especially when you're talking about non-spousal relationships. When you're talking about spouses, there's special transfer penalty rules that are waived when you're transferring from one spouse to the other. And if you're talking about at death, in Virginia, for instance, Elizabeth already said that if you do not provide the elective share for the spouse, her Medicaid office does consider that a transfer of assets. So it would be the same if you did and it was disclaimed, I would imagine. Right, Elizabeth?
Mm-hmm. Exactly.
Okay, thank you. Can you please further define the special needs? Does special needs include those who are afflicted by drug or alcohol addiction?
Well, I think the answer is going to tie into the Social Security definition of disability. If that addiction is such that you are unable to maintain substantial gainful activity for a continuous period of 12 months and you're not employable and you can't hold down a job, it's conceivable that you will be determined to be disabled using the federal definition of disability. That is considered a prima facie proof that you are disabled for purposes of these trusts. If you don't have that, then you may have to prove disability vis-a-vis any organization, any agency that you're applying for benefits to. So if you go to Medicaid and you say, I need benefits because I am disabled, and they say, well, do you have a determination of disability from the Social Security Administration, and you say no, then they have to conduct their own independent medical review and disability review, and they will determine whether or not your situation is such that you meet the definition of disability. So one way or the other, you're going to have to prove that you have a disability, and mostly you're going to confront the federal definition of disability as I just enumerated it.
Okay, and we just have a few more questions, so let's finish those up. If you draft a third-party special needs trust as a grantor trust in order to accomplish a better tax treatment, meaning it's revocable, will it still pass muster in the event that Medicaid reviews it to determine that the assets are not available to the beneficiary who is receiving Medicaid benefits?
I can answer that one. If you draft a special needs trust as a grantor trust, meaning that it's revocable, you are still entitled to take the money out to do whatever you want with the money, so it is not available to the special needs beneficiary. What you usually do in that instance is put a trigger, when the surviving grantor passes, the trust becomes irrevocable, and at that point, the assets are not available, and it would pass muster with Medicaid, providing all the other requirements are met.
Thank you. And we've got two more questions. If the children create a special needs trust for their parents, what kind of trust is it? And if income is not needed for their parents, can the children receive a K-1 for the income distributed to the children?
It's probably what you're referring to as like a standalone children's trust like we used to use when there was a difference between a 3-year and a 5-year look-back period for transfers to individuals versus transfers to a trust. Now that difference doesn't exist anymore, and it's 1 5-year look-back period for transfers to individuals or trusts, so most practitioners don't use a standalone irrevocable special needs trust, also called a children's trust, where money was first transferred to the children individually, and then the children created an irrevocable special needs trust and transferred money into the irrevocable special needs trust, and they used their parents as a life measure for the trust. The children can receive a K-1 for the income in that situation.
And if you're not talking about the circumstance that Ellen just described, where the children just, for whatever reason, they have the money and they want to create a supplemental needs trust for the benefit of a parent who has ongoing needs, there's nothing to preclude them from setting up a third-party trust in this fashion.
And they probably should set it up as an intentionally defective grantor trust, also called an IDGIT.
Thank you. In the event a spouse has recently deceased with no testamentary special needs trust created, can the surviving spouse then create the special needs trust prior to receipt of any assets? Note all assets were marital titled jointly.
So the answer to that may depend on the age of the spouse when the first spouse dies. If they're over age 65, once the assets are they're named as an outright beneficiary of the estate, they wouldn't be able to do that. What you might want to do in that case is seek reformation of the first spouse's estate plan and say that we want it to be a third-party trust. So before any of the assets are distributed out to the spouse and they take possession and control of the assets, go to the court, reform it into a supplemental needs trust, and then you'll have a third-party trust instead of a first-party trust. But
although you have difficulty here because it says here all the assets were marital titled jointly, which means by operation of law, upon the death of the first spouse, the other spouse is just going to own the asset.
Right.
So
now you're back to, if that's the case, you're back to finding out whether your surviving spouse is over or less than 65, and that will open up the door, if they are less than 65, to setting up a D4A trust with a payback provision. If they're over 65, you won't have the D4A option.
Or you'll have a pooled trust option.
Yes.
Okay, and we have one live question, and I think that will do it for our questions. So can we patch the question in, please?
It's
Sure.
from Alexander of Knoxville.
Yes, I'm sorry. Is there any reason why you couldn't, if I have a situation where the wife wants to protect her husband who's got dementia, why she can't just put all the assets in her name, then when she passes away, just use her will to set up the special needs trust for her husband? Is there any reason why we got to use a revocable trust during a lifetime?
Nope,
Can't she just
no
put
reason
the
whatsoever.
So just put it all in her name and.
No, you can do it that way. You just avoid. You're not allowing for lifetime benefits of a revocable trust that you otherwise have, meaning a successor trustee to take over during incapacity, etc. But you can do it that way.
Because when they die, if it's in a revocable trust, it's got to pour back into the estate anyway, so you're kind of right back where you started, it looks to me like.
Yeah, the only thing that you're losing there, though, is one of the other reasons to set up a revocable trust is asset management during incapacity.
Right.
You won't have that ability if you just simply scrap the revocable trust.
For the wife, for the well wife, if she gets sick, you're saying.
Right, for the well spouse. So there is some additional reasons why you might do a revocable trust, but if the only thing you're concerned about is the probate and you're feeling like you're just creating an extra step by having the revocable trust, yeah, you can eliminate it.
Thank you very much.
And somebody's asking what the defective drafted trust that you referred to at the end of one of the last questions is.
Intentionally defective irrevocable trust is an irrevocable trust that you add language in to make sure that you've got the grantor status for the IRS and taxpayer purposes. So there's grantor trust language that needs to be in there that will allow the trust to be treated as a grantor trust, and you want that so that the income will be reported on the 1040 of the grantor at the lower tax rate.
Okay, thank you so much. Well, thank you, Elizabeth, Howard, and Ellen. We hope you have enjoyed our national webinar, Special Needs Trust for the Elderly and Disabled to Protect Public Benefits, Crafting and Administering First and Third-Party Trusts, and Addressing the Interplay Between Special Needs Trusts, Guardianships, and Conservatorships. If your question was not answered, you may email it directly to our presenters. Their email addresses are included in the presentation materials. A webinar evaluation form will be emailed to attendees shortly. Please take a moment to fill out and submit the form to let us know how we did today. Listeners who have ordered or wish to order CLE credits must verify their participation in today's conference by submitting the completed attendance register that is part of the conference materials. You will receive an email with a link to the CLE form at the conclusion of the program. It is also available on the program page at the top right-hand corner. We will issue verification of CLE credits as they are granted by the states at a credit webinar event. If you have any questions about CLE credits for this webinar, please call our CLE service at 404-881-1141, extension 35. Again, that's 404-881-1141, extension 35. Today's participants can order a recorded version of this event at a special attendee price. Please call customer service at 800-926-7926, extension 10, or visit Stratford's website at www.stratfordpub.com. Please be sure to check Stratford's website for information on future Stratford CLE programs, including a webinar on estate planning for digital assets, identification, access, and ownership challenges, succession plan strategies for Internet and computer files, social media, and electronic accounts on Tuesday, May 13th, starting at 1 p.m. Eastern for 90 minutes. Stratford would like to thank you for your attendance today. To end this call, simply hang up the phone.